All right, we are here with another episode of Pure Perspectives, and we are talking jobs. Jobs have been taking the headlines this week. They've created some drama, they've created some firings. We're going to talk about what's going on with the jobs report, jobs numbers, and how that's impacting rates, because we're certainly having a good week in that regard. I'm here with Gary Pierce. I'm Clark Alexander. He's in Texas. I'm in California. A reminder, give us a subscribe, give us a thumbs up, give us a like, give us a comment. You guys have been doing a great job of engaging. We really appreciate it. It lets us know where we should be spending our time. Gary, let's talk jobs.
Let's do it.
What you
Jobs
got?
are
So the number
growth.
came out,
Mm-hmm.
and shocking, the number was incorrect. Is that a fair assessment?
Yeah, this has been an ongoing deal, right? This isn't administration. This isn't a Trump problem. This isn't a Biden. They just can't get this right.
Yeah.
Plain and simple. The Bureau of Labor and Statistics, that's why the chief was fired. I mean, look, when you have to fix the numbers because they're wrong every single time.
Yep.
Like there's like room for error. I get it, like statistical error.
Yeah.
But we're talking tens of thousands of either misses or gains. You go back 4 years, it was some crazy number, like 20 out of 24 months during the Biden administration, they couldn't get it right.
Not even close.
Not even close. Like
Yeah.
revision after revision after revision. So there, Trump obviously is a bull in a china shop, right? Like he's, but I think he just got tired of it. Like you can't make good monetary policy with bad data. We talk about it all the time. We joke about it, like, right? Gigo, garbage in, garbage out. And here we are. The problem is the garbage that goes out is out of your pocket. It's money out of your pocket, right? Because if we see numbers that aren't accurate, meaning we, the Fed, or whoever's making monetary policy, like they're saying, look, jobs are great. Everything's great.
Everything's great.
Well, guess what? They're not.
No,
they're not. The growth is to be, to what everybody says. So it's, to me, that's the biggest frustration, right? Like it's 2025. You can't tell me in this country we can't like figure this out. Like there's we can talk about stories forever, like on this subject, but miscounting, a job that's posted on 7 different job boards counts as 7 jobs openings. It's like, really? How is that even possible today?
No.
It's 2025.
Well,
right?
and the biggest concern is the impact it has on the markets, right? Like it's data that comes out, the market reacts. You're talking probably trillions of dollars are impacted because they're reacting based on this indicator of what the economy is doing. And it's a very major data point that is incorrect. Therefore, is it being played with intentionally? Who knows? But I agree. This has been going on for so long. It was time for a change. But I'd say the good news after the adjusted numbers were released, we're seeing some healthy movement. Are we not?
Yeah, we saw about a 12-point drop on Friday in the 10-year, which is great.
Big.
That equates to, I don't know. We're seeing 6.5 pretty regular now, whereas last week was 6.75. On a conventional loan. It definitely. So I always say this: in bad news in the economy means good news for mortgage rates. So obviously we're not sitting here promoting, people either getting laid off, jobless, or whatever. But those are the key points that actually move the needle from a rate perspective and how monetary policies, set.
Yeah, I feel like we're starting to get the movement we've been, I don't want to say hoping on, quite honestly, we've been planning on, right? We planned on
Hmm.
starting this year. We planned on,
Yep.
seeing a declining rate environment, which was going
Right.
to, impact the housing market in a very positive way. We're now
Yeah.
sitting here in August and we're just now starting to see movement. So, what that means going forward. I've keeping an eye on things this week. It was like, is this another just quick dip and we're going to go back up? It seems like we're holding steady here. Some movement, slight movement up and down day to day, but
Yeah.
generally, I would say it's a much more appetizing market. If you bought during the high rate period, it's probably time you start looking at rates to see what makes sense for a refi. We
Yeah.
can certainly help with that. And then, those that have, maybe been sitting on ultra low rates that they got, whether the pandemic or what have you, and need to access capital, and the 7+ rates have been too rich. Might be, if you're sitting on a bunch of debt, might be a good time to look at that too. So,
Yeah.
people ask, like, are you expecting the floodgates to open? I don't think that it's going to be a floodgates thing. It's going to be a
Mm-mm.
gradual movement, and it's our job to inform our customers on, like, wait, it's time to move. Things are trending in the positive direction. So let's get the conversations
Yeah.
going again.
Yeah. Absolutely. Reach out, talk to your loan officers, get your mortgage plan, see where you stand. If it makes sense today, pull the trigger. If it doesn't, you got time. See what the market does over the next, 6 to 12 months. I mean, it's very possible. Watch Bank of America, Bank of America CEO speak the other day, and their analysts are all no go on rate cuts
Yep.
this year.
Yep. Yep.
So, and I don't, the market's baking in 93% right now. I don't, I'm not that confident unless there's more negative jobs and inflation comes down.
Yep.
I feel like we're still in this, like, I don't think inflation is going to spike necessarily. I think it's going to stay slightly elevated in that 2.5 to 2.75 range, but the Fed clearly doesn't. Current Fed chair does not like that. And so, yeah, it's, we could, likely any big moves are probably in 26.
Yeah, and I think that's scary. You mentioned a good point, the mortgage plan. Like, hey, we're not saying the conversation needs to be we need to pick a rate and lock in. Let's figure out what makes sense. Like, what number,
Mm-hmm.
what rate makes sense for you to do it. So everybody's aligned. Like, hey, Clark, when we get to, when I'm
Mm-hmm.
able to get to, 6 1/8 on a 30-year fixed, like, I think that makes sense. So,
Yeah.
having that
Yeah.
mortgage plan in place, going through the numbers early, so you're not scrambling to try and pull something off because you see this ideal rate that may only be around for a couple of days. Like, let's figure it out. Let's do the math now. Let's
Yep.
determine what number makes sense. Hopefully, we're lower than that, lower than the ideal
Yeah.
number. But I think having that mortgage plan in place allows us to work together, and I can, raise my hand. Hey, it's time to go. We're at the
Yeah.
ideal rate. Let's capitalize on it.
Let's do it. Make it
Yeah,
happen.
awesome. Well, that's it for this episode, guys. Thanks for tuning in. Reminder: give us a like, give us a subscribe. We'll be back with more market news and other topics as they come up. But we appreciate your following, Gary. Thanks as always for the time.
Always. Thank you.
Take
Adios.
care, everybody. Have a great day.